Okay, right. Sorry guys, online. It's like late to start on this one, but we are in business. So we were all just watching the S&P on this. Absolutely wild. Ah!
They hurt you though.
Oh, we're not. There you go. Yeah, S&P is having a pretty wild open. I'll bring it up. I'll talk about it a little bit more in a moment, at least in my... I put a chart up earlier and I'll explain that in a little bit. What the S&P has done, very similar to yesterday in a sense, is put in an absolutely massive initial balance. That's what it did. Difference with yesterday, well, there's some similarity and some difference. Yesterday you had the open, it whizzed down and then reversed in the initial balance and put in this rather large move up. Today, the difference here being that yesterday you opened below the previous day's range. That's a good sign of weakness. It opens and it starts going to the downside. You think, well, that makes a fair bit of sense. If that can't continue though, then you run the risk that this is just an open test the previous day's low and drive higher, which is what you look at, or what you call it. Today, you've got it different in the sense you opened inside a value. So you would assume that if you open inside a value and very quickly move away, this is a change of people's opinion. Otherwise it would have, or it's a desire for people to come and sell it early. Otherwise it would have traded down here for the open, it didn't. So you take that, and certainly I did, to be a pretty solid reason to go down. It breaks a single prints from yesterday, it breaks away from all this value. That seems to make a fair bit of sense to go down. And then it flips over and absolutely rockets back up. Really, really difficult one to interpret in terms of what exactly do you do with it. There is one trade that I'll perhaps I'll put the chart up, which I can explain now very briefly. But in terms of where you go from here, and granted we are only half an hour in, so you could still get an even larger initial balance. It's a bit like yesterday where I would expect that any continuation of movement today, i.e. extension of range, is unlikely to be that big. I'm struggling to see how we won't at least break yesterday's high, just on the basis that that is a very bad looking high. We've already kind of, if you will, sort of stretch the elastic band down, pinged it up. It seems very difficult to see how it doesn't break the high. The bit that makes me, I don't know whether we call it nervous, unconfident, if you will, is this a 1 minute chart, and that's just one time framed all the way up for what, the best part of 15 minutes, just minute after minute after minute, every single one. If you bought on every new 1 minute candle and put your stop a tick below the previous, you'd be fine. That one ticks you down by one tick. I'm talking, sorry, 1/2 a tick there. So yeah, half a tick pullback on the previous candle. Every other one, if you put your stop below the low of the previous, it would have got you, you would stayed in and you'd still be in now. You've got a little flag. This could be the beginning of the next leg towards the upside. It's a difficult one now in that if you played it to the downside and didn't get out down here, which I'm struggling to see why you would have been desperately rushing to get exit down there. Yeah, if you played that on the breakdown, surely you were aiming for yesterday's low. So it's a really difficult one to understand why you would be out, in which case quite possibly you lost when you got this absolute rip back up the page. And now you're left with a large initial balance, clearly a lack of clarity as to whether the market wants to go up or down. It makes your life quite difficult, particularly if you just lost some money on it. Then this is one of those times to sort of step back and go, well, let's just leave things alone for a bit and work out what it really wants to do. The one trade that I put this up on the charts for a little bit later, but with regard to opening plays, so rather than just looking at the initial balance, because this is yet to be formed, but I think we're pretty confident to say it's massive. What you quite term it as, I think you could call it an open, test drive. I mean, you could also call it an open reject reverse. The bit that puts me off test drive is the size of the test, unless the drive gets even bigger, in which case just completely takes everything away from the day. But the bit that I'm more looking at, if you were to get on this move, the way to have done it is the opening range play idea. So rather than looking at waiting for the initial balance to form, you look at the initial movement. Now this is always a personally subjective thing, as in what you have to look at is, if you open there, the top of this red candle, you've traded down, that gives you the 61. We then trade up and you get the 69 and a quarter. So you're basically looking at where do you go in the first movement down, first movement up, and where are the sort of marks in the sand on those two. Then the idea is you play the break of whichever one, and that you're then playing for the open drive trade. It's probably really the only way to get onto an open drive. The only other way to get on an open drive is say something like yesterday, where you look at it and say, well, gap down, I think it's going to keep going, sell the open. That's the only other way to really do it. So that would be one of the ways to have done it. You then also got, when you come back inside this, on the basis that this is your kind of predictor of a potential open drive, when you get back inside, it's a failure. You can use the opening range to then play up from 61s. Equally, and this isn't to say that's the way to always do it, that's the way to play it in hindsight. I think what a lot of people will have done is sold 61 to play this to be the quick pullback, and then down we go again. So I don't think there'll be anything wrong with selling 61 and getting stopped out there once it's broken through this little range. Say selling 61, getting out at 65. I don't think you'd be wrong to do that. Equally, the other approach is you go, okay, that's clearly just a rejection, buy it through 61. It was a pretty spectacular move though. Like I said, I really struggled to see 83 not trade. We talked about this for those of us in here as well. It's gone now, or you can't see it now. But there was 500 lots in here at 74 3/4. That was persistent all the way down. It was persistent pre-open as well, around 69. You saw it down here as we came down. There was always, or not always, but it was often say a 400 lot on the bid, or a 200 or a 500 on the bids on the way down. Somebody is passively buying it. That's a good sign of strength, that whoever, and you can assume it's the same person, you're never going to know it is, but I'm going to assume it is. At least it makes my understanding of what's going on easier. If that person did not manage to get filled as much as they wanted to down here, well, what they're now doing is moving their bids up to try and get the rest of their business done, whatever that business is, or however much they want to do. So that's the kind of idea behind that. So a good sign of strength, particularly if they keep on moving it up. It suggests that there's a significant buyer. For a short-term profile perspective, if you keep this little pocket of light volume, if you keep getting the absorption here, which you are seeing, every time it trades there, they don't disappear, you could then try and buy ahead of that. Particularly if you're looking for that poor high to break, you could use that as your support area. It gives you a really tight stop just down here at 76.5. If you want to be a bit wider on that, you've got that large order that's down here and you could go behind that. But this is just a profile type of trade where you're using the light volumes on the profile, essentially playing long above here to try and get that next leg up. This would be another one where if it goes through the 83, this is one where if it zips through it and leaves a little patch of low volume, I would look at it the same as I'd look at this one and any of the smaller ones, similar to the way that you saw it yesterday at 54. That happens, then it's suggesting that this is buyers driving it through the level. It shouldn't really come back. So I think it's one where if I'm playing that, I'd be playing it on the basis that if it gets to 83, I'm looking for a quick whiz through 83, leave some single prints, leave some light volume, and that's the beginning of the move up. The thing, of course, to caveat with that is the size of the opening move. So, but what it would do for you, if it does that, is it will give you then a place for a stop. So effectively, if it zips over 83 and leaves a little patch of low volume like this, you could then go, okay, great. Put your stop below that little patch of low volume and leave it. It might keep on running and running and running. Just because the theory suggests it won't, don't believe that it absolutely can't, or don't talk yourself out of that. Right. We'll come back to the S&P. Okay, so yeah, that's where we were yesterday. Okay. So this is slightly different in terms of it not necessarily profile related, but it relates to month end. It is, of course, month end tomorrow. You can see the S&P is just around that 83 now. It is month end tomorrow. Can I explain why I said that Thursday would be a good one to watch? Watch the significance of month end and any expectations you may have in terms of market characteristics. Does it apply equally to all markets? It does apply equally to all markets. There are closes in everything. I don't know if I listed these on the sheet, but I can list them out for everyone. in a bit. And it's to a point where we'll look at it. What I think we'll do is you guys go and trade the month end tomorrow. When it's order flow week, next week, we'll go and actually review what happened and the things that you're looking for. There's not a great deal of value, in my opinion, of trying to guess the direction beforehand, of assessing it from a assumption of what might happen. I've always felt that that's not the best way to do it. Some people would argue that it is. What's happening then, so just to explain what's going on Thursday, with it being month end, there's an element of a necessity for a bank, a fund, whoever, to show profit. Now, if you're in a trade, you can't show profit. It's mark to market, but you're ultimately still in that trade. So unless you get out of trade, you can't show profit, which is also slightly an incentive for the people working in these places to go, well, look, there is the actual profit, not the mark to market profit, the sort of theoretical value.
So there will close no positions.
Yes. Now, there are different ways that you can go about doing this. And I read this last week, that one way you can do it, I don't want to get too complex here, is you can effectively enter into a repo agreement. So what repo agreement is whereby you take, let's say, some high value asset, some bonds, you sell your bonds with a repurchase agreement. So the idea is you sell your bonds and you agree that you're going to buy them back in 2 days' time, plus a bit of interest. Now, what certainly was the practice, I don't know if it is still entirely used as a practice, is you effectively sell your bonds for a lower value, you sell your bonds and receive less cash for them. You can then book that as a profit. So what then happens is you sell the bonds, you receive less cash, but that then counts as a sale, not a repo. So it's a way of then showing profit. If you're paying a lot of interest to do that type of transaction, then the risk you have is that, well, it's not the risk you have, you don't want to do it. You don't want to pay a lot of interest to be able to book profit to make it show up. So then you go into just selling the assets, which is the easier way of doing it. If you're long S&Ps, well, sell them. And that's how you get out of the trade. So you get a lot of flow going into the end of the month. That is not, I'm sure, the entirety of it all, and there's a lot more that goes into this. The simple take on it is you will see a very significant jump in volume in approximately the last 10 minutes in any market, the last 10 minutes of the cash session. S&P in particular, your average close volume on the final minute is typically around 40,000. This was last month's and it did 90,000 contracts in the last minute. That's not particularly big. I would expect it typically to be 100,000 plus, and actually probably really more 120, 130,000 contracts. That's why it's significant, because you're going to get an enormous amount of volume goes through in the final minute, but not just the final minute, even the last 10, you're going to see double the volume per minute over a period which is already generally double the volume of the average throughout most of the day. So it's a huge load of volume. What this means is that the market can become very, very directional, which is just what you want to see. This is what you got last month. The general approach is to, if you're looking at, I'll give you an example in S&P, but you can apply this to most things, albeit S&P is probably the one with the longest run up. Most markets you're looking last 10 minutes rather than last 15. But a lot of people will play the S&P for the last 15 minutes. You're looking basically for a jump up in volume. In this one, you actually got quite a noticeable spike of volume at 7:45, or at 9:45 as it was. Watch out for that. If you see that, it's probably worth going with it. You just go, well, let's just go with that. If it rolls back through that candle, well, fine, it's not working, you move on. People have various different approaches. One approach to it is people will go in at 7:45, 10:00, 5:00, 2 minutes to, 1 minute to, and out at 9 or 8 as it will be tomorrow. All in the same direction. My way of doing it has always been, I don't mind attempting that, but if the 7:45 buy or sell, dependent upon what the initial movement is at that time, doesn't work, i.e. starts rotating around me, I'll give that up and then try again at 10:00, 5:00, etc. What I don't want to be doing is buying it at 7:45, seeing it down here, buying it at 10:00, seeing it do that, buy it at 5:00, and then see it do that, and you just basically average down the move. My view on it is, look at the way it trades, look at the order flow. That's far more valuable than your assumptions on what it might be. If someone's got to buy and they've got an absolute mountain of S&Ps they need to buy at the end of the month, That will show up, you'll see it. Go with that, don't go with your opinion. That's why I don't hold any opinion on these. I don't think the technicals on the day help you. I don't think looking at the S&P and going, well, we're up on the month, therefore people are going to sell, helps either, because you don't know what their requirements are to be able to post profit at the end of the month. So broadly, I would just go look at the flow, look at the way it moves. I did send a sheet at the beginning detailing all of the closes for different markets. So basically take 10 minutes off that. I'll just write them in the group if someone reminds me later. I'll just ping them all up. But you've got closes starting off FX, then European bonds, European stocks, gold, gold, oil, treasuries, and S&P, NASDAQ. So you've got 7. If you really want to get into it and go looking at soybeans and stuff like that, you might be able to find another one. I think soybeans shut at 7. So you could do soybeans at 7 o'clock as well, just for that extra month-end trade. I've never traded soybeans on closes. I've never seen anyone do it. It could be something that everyone's missing. It might be absolutely wonderful. Go and have a go. What's the worst that's going to happen? You find out that actually soybeans are the place to be. And then you go trading soybeans or wheat or corn or whatever else you want to trade.
Is there liquidity in those markets?
Yeah, I've got a soybean ladder up.
Is it like a currency like euro, similar or gold?
More like a kind of gold. Don't tell me I haven't got. Right, there you go. That's soybeans. Just bear in mind, if you want to trade soybeans, you are now trading the January contract, so it's ZSF 25. So yeah, it's reasonably liquid. There you go. Someone was saying to me that the other day that soybeans are the best agricultural to trade in their view, mostly because that one does have the most liquidity in it. Some of the other.
Like a whole Asian market.
Some good stereotype in there. Right. Yeah, people need soy for a lot of things. A lot of it is for yeah, but there's a lot of it for animal feed as well. Soy, because you get protein, so it's quite good animal feed as well as just being human food, etc. Right. Okay. So another slight off-profile topic, but I'll touch on it briefly as well. Do any of you guys use bonds differential reaching certain levels as a confluence reason to trade? So this, what I'd call a bond spread. So this came up when reviewing Bund reversal from the trend day on Monday. T-note Bund yield differential hit 2% after a strong move higher, so a pullback in the yield, rise in Bund, drop in price. Wondering what you guys think about this. Okay, so what I've got here is a Bund T-note spread. Bearing in mind this is yield, so you've got to think about this as, for the price to go up, what needs to happen is Bund yields go up, T-note yields go down. So for the price to go up, Bund price goes down, T-note price goes up to some degree. Now they don't have to go opposite. That's the key thing to bear in mind here. They're going to get opposite of each other, but for price to go up, Bund prices have to fall faster than T-note prices. That's the key bit. It's not that common that they will go in complete opposite directions. Make sense?
But isn't bond price and yield inversely proportional? Should not move in opposite direction.
Bond yield and price,
Yeah.
but Bund versus T-note different.
Okay.
Yeah, so you're looking at the difference between two. So
They should both go together, like both economies are different.
they're both going to move together, but let's say you have a situation where these two drop and the Bund does that and the T-note does that. That one's gone further, so this chart would then do that because the yield will have risen more on the Bund than it has on the T-note. It's to do with the difference in the yields, not the absolutes. So what this is showing is the difference at this point is 2%, i.e. treasury yields are 2% higher than Bund yields.
So you're looking to play them to come out together.
No. Yeah, ignore it. Don't look at them. They don't have to stay in line with each other because interest rates in Europe are different to America, inflation in Europe is different to America, growth's different. It's a way of expressing a view about arguably the quality of one economy over another. 2% difference here suggests America's doing a bit better than Europe. Or be certainly a more favourable place to put your money because you're going to get 2% more than you would if you put your money in 10-year bonds in Europe. Anyway, so looking at this, I looked at this on a more detail, because this is a daily. I looked at it on more detail at about what time it was when we got down here. My estimation of this was we were around about here. So the highlight line around here in the Bund and around here in the T-note, right? Excuse me. So that was Monday. So what you're expecting for that to bounce off the level, so when it hits that low, to bounce off the low, what you're looking for is to sell Bund and buy T-note. That's how you would play that as a spread trade. Which if you sold Bund and bought T-note, your Bund's done that and your T-note has done that. So you're all good. You're a little bit onside in your T-notes and you're a long way onside in the Bund. Good trade. In terms of how you can use this to trade, you don't have to do the Bund T-note spread. One way you could look at it is say to yourself, well, if I want to be selling Bunds today for whatever reason, that's an extra reason to do it. That's the way that I try and think about that. Or it at least guides you that if you get some kind of bond negative news, maybe sell Bunds, don't sell T-notes. And if you get bond positive news, buy T-notes, don't buy Bunds, in terms of which one's likely to move more. The fact that they're both broadly trending lower, I would be looking much more towards Bunds generally. Wouldn't massively want to be buying bonds full stop. But if you have a choice as to which one you'd buy T-notes over Bund. So yes, that's how you use it. And it really showed up from here. So when you got down to the lows yesterday, your treasury's on the low, and then you get the treasuries explode off the low, the Bund goes straight back. This is a very distinctly different movement. So that's then the move is led by the Bund in terms of creating the bounce, and then the bounce is led by the treasuries rallying as opposed to the Bund falling. So, something to think about. Or an added layer of complexity if you don't want to think about it. Can't say, to be honest, that Bund T-note spread is something I look at a great deal. I'd far more look at the Bund Schat spread or the T-note T-bill spread.
I would take a trade more, but I would use it for extra confirmation. I think so. Just
Yeah. We'll go and have a look at it. We'll go and just put the spread on. I think you do it as 2-to-1.
where can we get this? We get them on Trading?
No, you can get them on Reuters. You probably get them on TradingView. Yeah, TradingView. Right. As we talked about it yesterday, I thought we'd come back and have a look at, well, turning the idea at the beginning of the day into a trade idea, which is the whole bit we were discussing yesterday on the S&P. The main bit of that was that, like today, you'd got a huge initial balance, or well, I say huge, rather large initial balance. It's what, 35 handles, that's pretty big at the moment. It's over 0.5% at least. 35 handle range. So you're looking at that on the basis that it's unlikely to extend to a great deal. So like I was saying yesterday, I expected it to break the high. I didn't expect this to go miles. So you could look at it as a couple of ways. You could just have a target zone of anywhere basically between the IB high and yesterday's high. You just go, well, if I'm long and it gets up there and stalls anywhere, I'll give it up. You could also look at that if you find any kind of reversal pattern, you could play that back towards the downside. So that'd be the other approach I think you mentioned, to try and play the short on it.
What's this gold?
S&P. And then the other part of it was, well, you've got the previous day's low, you've got the single prints as your area of support. If your view is that we're more likely to go and break the high up here, I'd prefer to be trying to buy this and play for that than doing anything else. So I wouldn't want to sell this. And like I said yesterday, I didn't have huge expectations you'd get all the way to the bottom. So you'd have to kind of try and buy the top, the sort of 57, 58 area rather than 54. And with the idea that you're going to hold that and you're then just going to do something like this profile wise, which implies a bit of that kind of chop for the rest of the day. So that's what you were looking for. The other part of this was the fact that yes, the day before was just stuck in there. If you were inside of the previous day's value, you expected to move through the value area. So it all made a fair bit of sense to at least go and try to get up here, possibly through the previous day's high. So that was the kind of idea of the trade. That was then the result of what you ended up with, which was basically the pullback on the D print. Nearly. The hard bit with these is always you've established your zones to trade. That's nice and easy. You know where you want to get to, you know where you want to buy it, you know where you want to go to. The difficult part of it was the fact that it never actually got down into this area. The C prints formed it and the D prints only went down as far as the previous day's low, so 59. So it's I'd say it's a really difficult one. You could go, well, I'll buy the previous day's low and the top of the single prints with a stop below them down here, which isn't, you know, a wildly risky trade. You're leaning towards probability that it will go and break the high. It's a 6 handle stop. It's probably not nice, but you're leaning on probability. You're right on this one. The other hard part about a trade like this is the time it takes to do it. Nothing says how soon it's got to break that initial balance high. And this is what you end up with, the C, D, E, F. F just about breaks the initial balance high. So you're waiting an hour and a half for it to go and break that high, which is all of this chop, 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 which is horrible to try and deal with because you've got to sit through all of this to get a break of about half a tick. And if you were trying to play for anything more and didn't give it up straight away, it then comes back on you and then goes again. So it's the kind of one where, like I say, easy to call what's likely to happen, quite hard to actually enact that. An ugly one. But it keeps you away from doing too much if it's going to be an ugly, messy day. If you say, well, I'm waiting to buy it down here, yes, you might not get to do anything, but you also haven't got yourself caught up in this absolute chop. That's the worst place to be. So you get in, you know, if you end up at yesterday at any point, long or short 65, it's a complete lottery as to what you're going to do. It might go up, might go down, might go anywhere. It just turns into a mess. And that's your 65. There's nothing to do there. That's why I always say, don't ever get caught trading in the middle of the range. You don't want to be caught trading in the middle of the range. You don't want to be caught trading in the middle of value. If you're doing that, you just, well, you're at the mercy of guesswork, really. And that's about it. It feels similar at the moment in the S&P, if anyone's watching it. It's just constantly up and down, up and down, up and down in this. Yeah, there you go. It's just chop, chop, chop. 82.5 to 77.5. It's just sideways, sideways, sideways. It's going to move out of there at some point, and you would expect, seeing as we've had the best part of nearly half an hour there, you're going to get a quick move, whichever way it goes. Doesn't mean it's a long move. You know, you could have a quick move to 69, quick move through the highs of yesterday, which I don't think would be long-lived or sustained, but you're going to get a move somewhere. So we'll wait and see on that one. Sorry?
There's a buyer and a seller, so.
Mm-hmm. And that again, it's a really bad one. If you're stuck long at say 80, you're right in the middle. You're completely 50-50. Like if you're long at let's say 78, or you're short at, I don't know why you'd be short at 82 because it's just below that bad high. But if you're short there, you've at least got a clear stop and you've got to go across the range and break for your profit. So it's a viable trade. Where you don't want to be long is long 80 because your stop is probably as big as your target and there is nothing leaning you to be more likely to be one or the other in terms of direction. What chart would you recommend for the S&P for the first hour and a half in the morning? I think it's worth, if you're looking to try and understand what's going on in the IB, I think it's worth getting a 1 minute chart up. Certainly if you're going to try and look at the opening range plays, that's going to be really valuable because it will establish that open range for you. This is a 15 minute. Now, you've got your IB, which is the first 3, 1, 2, 3. That's that. This is yesterday's chart. I don't think that's really going to tell you a great deal. Yeah, you could look at that and say, well, there's the open. So it's an open test drive-ish, but a bit like yesterday, is you struggle to call it an open test drive when it closes down here. So if you look at the range or the body of that first hour candle, it's only there with a wick like that and a wick like that. It's not actually indicating a great deal for you. So it's worth kind of thinking about it like that as well, the sort of what exactly the sequence of action is. For a proper open test drive, you would have wanted it to open here, trade down and close here. So then you've got the body of the candle that's a bit more like that. That would be a more convincing open test drive that is actually at least stuck with the idea of that move rather than just gone one way, gone the other way and happened to stop somewhere in the middle. So that's the way that I try and interpret that. S&P touched 83.
Yeah, touched 83 is good off,
Yeah, can't believe that. That is quite remarkable to have done that. But it has. So we shall see if it can finally get through it. I need to check that precisely actually, if that is definitely the...
83. We did one ticket, bro.
Yesterday, yeah. My profile I've got on a quarter tick. Oops. Sorry, on a half tick. So it's actually 83.25 was the top of yesterday. So it's done a quarter of a tick shy. And then roll back. You surely think it's got to go and touch it, or at least just get through it. You'd want to see. But this is what traps people, and that's something else to think about. Profile's quite good for showing this type of thing. That what you're getting at the moment, and I'll ping the profile up that you've got now. So that's what we had earlier today. So there's your open range trade. You play the break of 61. So this was the chart as I put it up as it was happening. My view being opening range, you play the break of the opening range, you play this for an open drive, which took you down through this area. You're looking at that thinking, yeah, this is going to go. If you played it from the 61, and this is why you look at these opening ranges, particularly when they're quite distinct in the sense that this has gone open, test, and back to the middle, it's very clear where your range is. The harder ones are where it does something like this, and then there isn't really an opening range. You can't just sell the low. But if you've done that, are you looking at that? If you've sold it here, you're looking at that thinking, yeah, this is horrible, but people are going to take their profit after such a quick drop. It's all right, I can keep my stop up here, or even keep your stop just above 58. So you might even, if you want to be really stingy, move your stop down to 59 and do it like that. But whichever way, you're probably thinking, I'm all right. At worst, it's going to retest and do that and go down. Obviously it didn't, and that's where we are now, but that's kind of what you would have expected to happen. From the perspective of now, and this is something that you want to be very, very aware of, right? We did a load of volume in this same area yesterday, up towards the close. That's really obvious, that high. There's going to be a lot of people trying to play for the break of the high. Now, if they're not in for much lower, most of them are probably going to be in somewhere in the high 70s, low 80s. In fact, I'll just see if I can let you know on that. I'd be surprised there's no one in. It's just surprising the lack of people playing that. I thought there'd be a fair few more playing it.
It just keeps going up, rotating backwards and forwards though, which
yeah,
has nothing to do with it, and they're thinking, well, it could have gone by now.
I think there is a bit of that. I'm surprised there's not a few people who would normally just get in and go, it's going to do it. Stick your stop below 78 and just leave it, let it do it. But what this is doing, you've spent half an hour, if not longer, up there. There's loads of people who are all probably playing for the same thing, short time frame people. Perhaps the reason that you're not seeing it here too much is everyone got burnt on that move down and went, I don't know what's going on anymore, leave it alone. Also, you've got the UK budget that people are looking at as well, which is taking a bit of the sort of lean. One person short Bund again, playing for the big breakdown type move, which you've actually got now. But he's been playing for that for a while. He's kept sort of going for it. He's finally got it. Anyway, my point being, if lots of people are expecting this to break, you end up with an accumulation of longs up here. The risk is that it rolls through here and you get the rush down. That's the thing to always kind of think about with these. When the theory is very clear and there's a very clear place for everybody to get in, probably the more dramatic move is going to be this. Equally, if lots of people have all sat here buying it, when it goes pop through 83, if it does, a lot of them are probably going to go, thank goodness, get out. They're pretty relieved. They've sat here for half an hour waiting. The relief of, oh, it's traded 84 is enough to get a lot of people to go, fine, let's just get out. And that in itself limits the further upside. So you've always got to kind of be aware of what other people are likely to do. There's probably a lot of people with an offer like there going, go on, just pop the high and we'll just get out. So just bear that in mind. You could be just running into a lot of liquidity on the break. And if that happens, then also the ideal scenario here is that it goes tick through, rolls back, and then you sell it through 83 for the breakdown to catch out all the people who didn't get out on the initial break. The diehards have gone, no, this is it. It's going to be really big. And those people all get trapped and caught out on it. That's the bit that I think...
So that large IB was like an institutional buy, and then now the break is going to be just a retail?
I don't know. I try not to think it's an institutional thing or it's a retail thing. It wouldn't surprise me if this initial move, there was somebody thought, right, we want some better prices. Just hammer it down real fast. Get a load of people selling it because you're moving out of a very tight range. Mop it all up and just buy. I don't think that that's unlikely. Can I prove it? No. Do I know what their intention is? No. I have no idea. But that I think is what a lot of people have played for.
Referring to today's profile retail.
But yeah, certainly up here now in the S&P, I would think there's a lot of retail people just all playing. Retail short time frame traders, a lot of people playing for that. I can't imagine there's that many proper retail people buying 78s looking for 74. Most of the more retail people have probably been trying to buy the dip and hold this, and they're all looking for record highs. And that's where they get it wrong, because then they try and play for something that's just not going to happen. But yeah, after the ferocity of that first movement, to get so pinned is quite an odd situation now in the S&P. It's going to break at some point, and it's probably going to be pretty quick. Right. This is where we were when I put this one up in WTI. This strikes me as a market that doesn't know what it wants to do. So this was the initial balance at the time, which is mostly the entire initial balance. It puts in an opening range, which takes, well, it doesn't take long to form, those being the 2 points. So a little bit like S&P, it has quite a distinct down and a distinct up. So that's nice. You then look at that going, okay, well, I could play the break of this to establish some degree of direction. That one fails, back in. It falls out, it doesn't stay out, it comes back in. It's left a reasonably, unless this put in any huge initial balance, no it didn't, a reasonably small initial balance. It's also tested the gap. That to me looks like one where there's still some potential in this. The longer and longer it sits here, the more it loses potential, because it's going to struggle. What you got to think about is, if you establish value here, to move value, you're moving a larger amount. When you think about trying to move an average, if you've got an average of 100, to move 100, you need a lot more value traded at a higher price. So if you've got an average of 2, you only need 2 traded here, and that shifts your average up. So think about it like that. So yeah, there you go, the S&P is just broken down now. So what you're going to get is, the longer it sits here, the less and less and less it looks like a market that's going to move, or move in any kind of meaningful way.
If it does a couple of 3 or 4 days like that, Rich, then it's more scope.
Yes, that's the thing you have to always sort of think. These two are nice and balanced, which suggests potential for movement. So you're kind of weighing up what's going on here. It's nice and balanced. We have opened higher, so you've got this kind of gap up, which is roughly kind of gapping out of this recent range. This is a 60, and that's a 1. You're getting out of this range, you've got a big space to go back up into, which is back towards where we were trading before the Iran de-escalation story. So you've got the scope to do it, and it's not doing it, which isn't a great sign for buyers. But it's equally not going down. You would be looking, if you're a seller, you're looking at this thinking, well, if you're inside of yesterday's range, then you want to see what it can do when it gets down to top of value. If it doesn't bounce from there, I'm looking for it to go down here. If you're a buyer, you want it to stay above these two and play the break of the IB towards the upside. What you've got so far is a market that's done a whole lot of nothing and has left us there. So you're still sitting in a kind of world of uncertainty. The one thing you have got is what you could call a failed auction, where you've got the initial balance, tests out, falls straight back in. So that's your failure. Yeah. Think about it from the point of view of, well, yeah, one balance day, but also, if you're a buyer, what did you need to do today? You needed to get it up above here. If it got above the initial balance, this is good. It's time to go. That was the big chance, and they've not taken it. So that's a pretty bad indication for buyers in this respect. Yes, you've got the oil data coming up. Oh no, it might have gone now, hasn't it? Oh, yeah, it's 2:30. That was probably it, actually. Yeah, there you go. So the oil data gave you the chance to go, and it did absolutely nothing on it. It rushed it and nothing more. So increasingly, this looks like a day that is running out of anything in it. You possibly got a trade from 40 still, on the basis that this just won't break out, selling towards the top of the range to try and get the break of the IB low, possibly a test of value. That's probably about it. The thing that keeps your hopes up is it's quite a small initial balance, which would suggest if it does get moving, it's got some scope to move. But until it does that, I really don't think there's much in this. It's a pretty dead looking market, which is not what you'd expect. Yeah, I certainly would have expected today. Yeah, this was the one I was confident of thinking something's going to happen today. But this way you have to then just take on the info that comes your way, and it suggests nothing is going to happen now. Then you're running out of time for it to happen as well.
Richard,
Yeah.
you know how you get single prints on the wicks of candles?
Yes.
How do you know if we will break the top or just rebalance it and run?
So you're talking about, say, here.
Yeah, where you start to get single prints.
You don't, as they're forming, no.
After?
Once they've formed, yeah, like, so the idea here that I guess the D print hasn't finished.
Okay.
The fact that this broke a level at 40, you could sort of go, well, and looking at the way it did it with that just flick up on the data, you could say, well, I'm reasonably confident that this is probably going to hold. What you really want on a single print, so as this is forming, as the D print trades up, you don't want to see it back below 40. As long as it's not trading below 40, you can kind of play it on the basis that this will form a single print once the E print comes in and it won't trade back. Okay. If it goes up and falls back through the level that creates the single print, then you could sort of infer that it's probably going to be a tail and play it for the downside. It also, with any trade like this, what I like about it is it's showing you where your stop is, because buyers have got it up to 50 and nothing more. So if it goes beyond 50, buyers are now back in control. I don't want to be short anymore, but it at least gives you quite a clean stop that you can sell 50 and put your stop at, sorry, sell 40 and put your stop just over 50. So yeah, now you're back there. Now it's, especially if it hasn't got enough in it. Yeah, the way that's trading, just look, is, you know, when you just first look at it like that, it's barely moving.
It just feels like last it's
Yeah.
all day long practically, I've noticed, yeah.
And so you look at that and you think, well, it's not likely to go rush into the upside. You know, why is anybody suddenly going to change their mind and come and bang this towards the upside without any news? And they had some news and a reason to do it, and they still didn't do it. So it does lean towards, if you want to sell it, you can sell it there and put your stop above the high and go, well, it's, you're playing on the kind of basis of there's a lack of people buying. The difficulty with that trade is it doesn't suggest you're going to go on side very quickly, and in an hour's time you could still be sitting here wondering, are you right? Well, you're not wrong, and that's the difficulty. Whenever you have a market that it's just got nothing in it, you're not wrong, you're not right. So you're kind of just at the mercy of whether it goes to 52 before it goes to wherever you're targeting 12s, and it's kind of, yeah, it is a bit of, well, let's just wait and see. My risk reward's okay. I don't think it's going up, and that's about it. But that's all you're playing on.
Maybe scale back, you get more confirmation.
I think you just don't bother.
Yeah,
Like if you're trying to do something and nothing else is going on, why do you want to do it apart from your own desire to be in a trade? And apart from that, I don't think there's any reason to have been in that trade. So yeah, it's one to leave alone. I got asked a question because talk about the open the Bund and the open in the S&P yesterday. I think I kind of covered the open in the S&P yesterday, but the open in the Bund today, and this is a question someone else asked as well, about do you look at the initial balance as the first hour, as it's always the first hour, do you look at it as 7 till 8 UK, or do you look at 8 till 9? That's the cash, and that's what I call the Eurex open. It's not officially, the Eurex open now officially is quarter past midnight. Like with the US markets now, they open in the middle of the night. However, this was always traditionally the Eurex open, bearing in mind that that will be 8 AM in Europe rather than in the UK. So it's a bit more the time that they're going to start trading. What you get and what is noticeable is the pickup in volume. It's not dramatic, but even if you look at the average volume, you do get a pickup in average volume at that period of time. So that factors into the using of the IB. When someone asked yesterday about should they make their IB wider to incorporate an hour and a half before the US Open, my answer to that was, well, look at what everyone else is looking at. I don't know anybody who looks at anything other than the 7 till 8. Everyone still looks at 7 till 8, and they run their Bund profiles, excuse me, 7 until 9 o'clock. That's the way that everyone does it, and that's the way that it still gets done. So I think you kind of have to look at it in that respect. In what you've got today then, if you go from 7 o'clock, which is here, you've got a relatively small non-directional initial balance, which is this here. What it has done for you is gone and tested the single prints, the previous value area low, basically the points that we broke down from yesterday. So you can look at this, well, there's two things to look at. You can look at the 7 till 8. You can also look at the 8 till 9 as well, which is equally nondescript. That's your open and that's your close. Yeah, that's your close. And then you have the German data. So it's very hard to go, oh, look, it's a wonderful reversal IB break because you're selling the German data, which, okay, the German data supported selling it, but you're not really trading the technicals on it. If you took the German data away, because there's no way I'd be trying to sell this into the data, take the data away. If that was not happening and you got this end print like that, that's what I would call a failed auction. Now, failed auctions are the kind of things that you have to be semi-looking for in order to trade. I don't mean you can look at it and go, oh, look, failed auction, I'm going to trade it. So what I mean by that is you're almost always going to get a market that ticks a bit outside of the initial balance. And it doesn't always, in fact, a lot of the time, doesn't do this type of thing and just single print through. Even when it does, it wouldn't shock me if the actual break here, and we'll go on the chart, did something like that before it goes down. So even if you just sell the break of the IB, it doesn't mean that it won't revert back in. But the idea of the failed auction trade is that if you're already thinking, I want to sell it up here, which I think is quite fair, it's the single prints from yesterday, it's the value area from the previous day, you're trading up here when value's down here as well, which is not, well, it's not typical, but it's a kind of trade where you're looking that if this doesn't establish value higher very quickly, it's always got the drag back down anyway. So technically this did what it should have done. It did it because of the German data, but I wouldn't have written off this as being the case anyway today, that we would have gone and got sucked back down here. So on a trade like that, one like this, take the data away, I'd have quite liked to take that on.
I was going to bounce off that. This says value.
Bounce from here.
Oh, a bit higher up, but I didn't know the day was going
There. Yeah, you could play that on a normal day. I still, when you've got very rounded out value, I'd far prefer to be short into that than trying to buy from the top of value. Just because it's so nicely rounded, it's quite hard. Yeah, it's easy enough to go, well, there's the top of value, but I'd always want to couple that with a chart as well. You're not going to have much of a level there at 65. And remembering that from the days before, 58 was really the level. So I wouldn't want to buy just the top of value. I'd far, far prefer to be short into it. And when you've got very, very well balanced area, particularly from a time perspective, if this was more smooth there, I'd really want to be short into that for the sweep through it. It does it anyway, but I'd have even more conviction if it was completely balanced out. It's not quite.
The single B for the tail, that's
Sorry?
the single B for the tail, it's most likely going to go. High probability that will go on the previous day, which
Here.
yeah.
So
When is that B right at the bottom?
that,
Yeah, what's in
it's just one letter. So it's one tick through the low. What this is what I would call a fat bottom profile. That what's happening here on the previous day, I probably should have put a chart up of it. What's happening to create a fat bottom profile is essentially people try and sell and sell and sell and sell and sell and they don't get anything for it. So it's not a flat bottom, bad low as such. It's not that it's been stopped at a single price, but it's that sellers just run out down there. What you've got to think about in a situation like that is somebody who's selling it down here and keeps on trying to sell it is not necessarily someone who's getting out. Therefore, if they're short now and they don't get out, and let's be fair, they're probably not going to, at least until you're up here somewhere, if you're longer term. So if you're not going to be getting out, for this to break, what you've now got is lots of people short. You need new sellers, which means the break is very difficult to get because you need someone else to come and sell it because all these people have already done it. So they're waiting for it to drop and they need new sellers. That's the difficulty you have with the break. So in terms of a target, if you've dropped very quick to here, I'd be very keen to exit that, unless this has got loads and loads and loads of volume in it. And yes, it has on the data, but it needs to stay down and it very quickly bounces back up to here, which is roughly around this area. Once it's doing that, that's not what you want. You could have one more go and try and play this as a pullback and a continuation down, but as soon as it starts ticking above this zone here, you've got to give that up.
It's hindsight, but the break through that balanced area and then the failed auction, like the failed break and then back through it. Still high probability. That's hindsight.
Well, you want to call it high probability, I don't know, but you could certainly look at it and go, well, if it's failed to break at a point where you really need it to have a lot of volume and drive through, then yes, it's probably quite fair to try and play that back up. So yeah, I don't think it's unprobable. It's a bad word, I don't know what, improbable. And also you've got to look at it from the point of view of, well, if it fails to break the low and gets back inside value, you know where your stop is. Put your stop below the low, buy it with a target up here, or a target at the 9 o'clock IB low, which is 72 there. It's quite an attractive trade. So yeah, I think you're fair to play that. But on the failed auction, these are the types of ones you've got to want to be short anyway. If you're not sure, you run the risk that it goes tick, tick out, falls back in, you go, okay, I'm gonna sell it, and then it does that, because you haven't got a great deal of reason that you want to be short. I think there's fair reason to want to be short here. So the failed auction just facilitates that trade rather than it being a case of, because if you do that every day, you're gonna lose a lot of them. Your target on a trade like that is a minimum of break the other side of the IB. Then it comes down to whether you have any other direction that you're looking for. Yeah, I think very reasonably, if you're playing that, you would be looking for this low, which is 71, 72, and then you're onto that question of sweep that through that value.
On this note, do you just keep the profile for the current day? You have that split at all times, Rich? Or do you like go back and forth?
I interchange between it. I generally prefer to not have them split, but I will split them out, like just to kind of see where the different sort of pockets of volume. You know, for example, you look there, it does not seem to want to trade in that area. Yeah, it's always single straight through that. So that suggests that 69 to 61 is the zone where you're either above it and you're going up, or you're below it and you're going down, but you don't want to make a decision in the middle because it just whizzes through it. So you could almost sell a break of 69 or buy a break of 61 and play it up, assuming it will at least go to the other side. That's why I kind of look at that. It has finally broken as well, which on the point of it needing more volume to do it. I'll put this back onto a 7 o'clock chart. There you go. So that's your fat bottom part of the profile, right? So like I say, you need it to go down and trade through this with a lot of volume. When you look at it like that, you can see why 68 is key. It's basically just the upper side of this range here and where all the volume is. 61 less so. Don't see a huge significance in 61 apart from basically it was just the highs of this pullback. The old level was 58, which was last week's lows. But like I said, to break these poor lows, or sorry, not these poor lows, these fat bottom lows, it needs to do it with volume. It's got to go down there and really drive into it, which is what you get here. So you get this real solid drive of volume, pretty much from once the S&P, not from when the S&P opens, an hour after. Once you've got that, then you can believe in the break. Particularly then when it drops down to here and you just see it bounce off that level as well. That's the one you're playing for a break. One person certainly played it. It's partly why a lot of people didn't play the S&P, because a lot of people were short burns. That's a lot of people still short burns. Essentially just playing for that continued move down. There you go. So it has broken now. It's done it the way you'd expect it to do it. The one thing to point out on these fat bottom ones as well is if you're opening inside of this area, which I appreciate we weren't today, if you're opening inside of here, same principle, you need a lot of volume on the break. If you don't get it, what you've then got is lots and lots and lots of people short. As you start to move up, you don't get this kind of rush because they're not all short in the same place. You know, some people would have been short from up here, some people are selling it at the top of this range here, some people are selling it towards the lows of the range. There's going to be a big sort of dispersion of where everyone's short in this. As it starts to go up, people will steadily exit, so you can end up with either a high volume break or you get this kind of low volume steady grind move back up. So you have to kind of think about what you're going to expect to see on a move like this, and it's really key the understanding of what to expect rather than just, oh yeah, it's going to go up or it's going to go down. It could go either way from there. But the key is the way it does it. If it goes down to the lows or not particularly good volume, then it will give it up and it will just rotate back up, which is what it's done here, what it's done here. If it goes down with good volume and increasing volume, then it will stay down and it will keep on going. So I hope that's kind of covered that one for Peter. Excuse me. It does give you, on the point of if you look at the 8 till 9, you did have a chance then on that German data to play the break of the 8 till 9 IB. So you play it through the 72 and play for the sweep of the range. So all is not lost, even if you missed the first 30 ticks of the data move. Right. No, that wasn't one. Right, I'll bring us back to the S&P for a bit, just to see. Oh, oil. There you go, so that one's done it now. Yeah. There you go, it got above 40. It's increased the volume. I wonder if... I'm not seeing any news around that. No, that was last night. Oh, wait.
So now we want to see if it shifts value or...
Sorry, oil, yeah, that's the key bit now, whether it can shift value. But I'm not seeing anything there that really makes me think that this is, you know, a huge reason for oil to be rallying. So it does seem more technical. Yeah, absolutely. Now that you've done this, like I said, it doesn't, I wouldn't rule out the continuation up now because of the fact that you've got a small initial balance.
If we close out a value and then shift it up, maybe look for short tomorrow? Or?
Yeah, but you've got to think, what you've got to remember here is we've got hours left. You've got 4 hours left. This is a quick move up.
And this gap isn't there as well.
Yeah, there's that huge space to go into. So there's a lot of space to do it. And the thing is, with it not shifting value, it doesn't mean it can't do the full gap close before it shifts value. So it could do the whole thing and then sit up there and shift value. It could do the whole lot and reverse it if it doesn't shift value. So it's always one of these that you know it needs to, but the order in which it doesn't really matter. What it does affect is the way it's going to move. So if this is going to trend day, then you're going to expect it to shift value before it does the next leg, i.e. it's going to trade up and down in here, build value, get some volume up here, which is kind of what it's doing at the moment, and then it will put on another leg, same again, and another leg and another leg. If this is a liquidation, getting rid of all the shorts that were short down here, and the people who sold it in the overnight session at the beginning of the week, then those people aren't going to hang around and wait for value to shift. If they're short and they want out, they're just going to get out, which can create this quicker move. So if you're not already in, you're now looking at this from the perspective of, well, you've got two choices. You're either trying to buy a pullback or you're going to try and buy the break of the high. Buying the break of the high is going to be a trickier trade, obviously, particularly as I don't think there's much of a level around 84. You're kind of middle of nowhere. So I don't really want to be buying that. So then you've got to look, okay, well, ideally you want it to have a pullback if you're not in, but also if this is going to sustain the move up, you want a pullback, because in doing a pullback, it's going to move more volume up here. Something that's always worth knowing or looking at is what the size of, where is it? There you go. There you go. So the VPOC today is 4,500. The VPOC yesterday was, oh sorry, that one day was 5,600. And down here, 5,500. So that's a pretty solid, where's it gone? That's a pretty solid VPOC, i.e. it's not going to find it too easy to move that and make it trendy. You'd have to put in another VPOC much, much higher up. So it does lean to the idea that this isn't going to shift value too far. You're probably more likely to get this kind of stretched, sort of elongated value area, a bit like this kind of idea, than you are to see it sort of value. I wouldn't completely rule it out, but I'd be somewhat surprised, in which case you kind of want it to go quicker. The sooner it goes, the better, because then it doesn't matter about shifting value. If this goes and pings up the page towards, I can't remember what the target was. Yeah, that's what I was thinking.
Yeah.
Somewhere like that, then you're fine. And the quicker it gets there, the better, and then you just give it up, because the further away from value this gets, the less able it is going to be to stay up there. At some point, it's just going to roll back. Particularly as well, think about it from the point of view of everyone else who's long. If this whizzes to the gap close, they're all going to run for the exits and bank their profit on it. So you're not going to get many people buying it either once it's closed the gap, because the job's done. So you could see this quite sort of fast rip up, rip back type scenario. But the way to do it, if you're going to try and do that short term is you just look to try and buy above these little pockets of low volume. So down here, which is, we kind of just saw it trade down to. Yeah, it's 70. That was the place to have bought. Easy in hindsight, but that's always the way I look at these. You've also helped out because you've got this previous VPOC from this day. So you're already above this one, but yeah, you're still looking for that one to trade. So I'd be looking 69.75 as a first target, and then yeah, you go back for the close as well. But yeah, it's at least doing something now. It's on its way. Unlike the S&P, which is on the complete, well, not the complete opposite. It's had its absolute whip around at the beginning of the day and has now decided it's going to do very much what it's done the last couple of days. And it's just back in this area again. So a bit like yesterday, same game. You've got a massive initial balance. We've one ticked the high. It's unlikely to break the low now, I would think. Same game again. You're looking to buy it down here and play it back up. That would be my kind of main thinking today. I wouldn't want to sell the top because I think there's a risk that you get some stops hit over the high there and you get that kind of ping up. So I wouldn't want to sell it here until it's gone over and then failed and back. But that would be the case on any kind of large IB day. I'd then be thinking somewhere down here. You just got to try and basically find your support zone. It could all come back to this opening range scenario. That was 60. I don't know why that's moved. There you go, 61, 67, or even beyond that if you go a little bit higher. 61 to 69, now it's holding 69. If you called out your opening range, well, that could be, in fact, yeah, that is the opening range. That was the 1 minute chart. So you could then use the top of that as your way of playing up. Just stay aware that if that's a buy, 61 is still a buy as well. So you've then got to decide how you play that. Do you buy 69 with a stop just below, or do you buy 69 and 61 and 58 on the basis that it won't break the low and you might be able to get out through the high? It's quite a big trade to try that. Micros, probably the way to do it if you're going to try and do that. But yeah, it's done exactly the same as yesterday. Increasingly, I look at the S&P and think it's waiting and waiting, possibly even for the election, which is unfortunate if that is the case.
Is that what usually happens in history? Direction you get the direction?
I can't say, to be honest. I've not seen enough elections. Yeah, realistically, I've seen 2020, 16, 12 and 8. So I've only seen 4 elections. One of them we were in the midst of a financial crisis, so limited action. The Trump election was basically just buy the dip and hold it. 2012, I do not remember at all. And 2020, I couldn't tell you what happened. But again, you were coming out of COVID. So, and it was, in fact, I think 2020 the election was just before the Pfizer vaccine. So straight away, whatever happened was far more contingent on the Pfizer vaccine and the reopening of the economy than Biden winning over, was it Trump? Yeah, I think he beat Trump at that time. So yeah, I would say off 4 elections, I couldn't give you any kind of definitive backwards looking view. My view on generally in politics and elections is, in the long run, has 0 to do with the economy. Politicians put a lot of emphasis on their impact on the economy and the way they've changed things and they've improved all of this.
And what they say they do to
well, yeah, there's that, but also anything they do doesn't massively have a great deal of impact. The biggest impact they have is if you have very dramatic tax changes. That's the way that politicians can affect an economy. But outside of that, you don't get much. Right, I think I'll probably wrap it up there. We covered a fair few bits and pieces on opens. Friday, we've got a task. What I'll ask people to do today, if you could, and I'll take the first 8 of them. Somebody put in the group any date between now and we'll go back as far as March. So from the end of March until now, any date you want, just put a random date in. This is not me trying to work out when you were born or any other questionable information like that, but it sets up what we'll do on a Friday. So whatever date you want, and I'll take the first 7 or 8 of them. And if it's a weekend, don't worry. So just pick a date. Right, I'll leave you there, guys. You'll find out why on Friday. See you tomorrow.
Just pick a random date and you'll find out.
It doesn't need to have significance, or
If you want to pick a significant date, you know, your anniversary, the day you got a cat, the sunniest day of the year, whatever it is, go for it. Or just pick some numbers. Or pick a number between 1 and 31 and month between March and September, October. Do it that way.
Before I run those opening range, is it the same as IB or?
No. Initial balance is the first hour, so it's time-based, it is distinct. The opening range is a subjective assessment of where the market is traded within the first, roughly, if you want to put time on it, within 15 minutes, and actually I would often say